Buying a great company at the wrong price is the easiest way to lose money. Most retail investors blindly assume that all fast-growing stocks are great investments right now. They look at past returns and expect the same trajectory to continue forever. The truth is that price is what you pay, but value is what you get. When a stock trades way past its intrinsic value, the downside risk becomes massive. Today, we are breaking down 20 global stocks that are currently completely mispriced. 10 of these companies are massively overvalued, trading at highly dangerous premiums. The other 10 are heavily undervalued, offering excellent margins of safety for your portfolio. We will look across the US, the UK, and Europe for these opportunities. Before we look at the cheap stocks, we must identify the dangerous ones. What most people do not know is how quickly an overvalued stock can crash. Even if the underlying business is growing its revenue, the stock can plummet. This happens when the market multiple contracts to match reality instead of hype. A prime example in the US market right now is Nvidia. Nvidia remains the undisputed king of artificial intelligence chips and hardware infrastructure. However, the stock currently trades at a forward price to earnings multiple over 40. Its price-to-sales ratio has pushed past historic, unsustainable tech bubble levels. The market has priced in flawless execution for the next 10 years straight. Any minor deceleration in data center spending will trigger an aggressive correction here. The valuation risk is not just limited to the tech sector either. Eli Lilly has experienced an astronomical rally driven by its weight loss drugs. Zepbound and Mounjaro are generating billions of dollars in highly lucrative global revenue. Yet Eli Lilly now trades at a trailing price-to-earnings ratio over 80. It is currently valued higher than entire European economic sectors combined. The market is completely ignoring upcoming patent cliffs and rising competitive threats. Meanwhile, over in Europe, ASML is facing similar overvaluation pressures. ASML makes the lithography machines essential for advanced semiconductor manufacturing. It is a fantastic monopoly business with zero literal competitors globally. But trading at nearly 45 times forward earnings limits future upside completely. The cyclical nature of semiconductor chip demand means a slowdown is inevitable. You cannot escape valuation risk by simply hiding in defensive consumer stocks. The surprising part comes next, because even boring companies can become dangerously overvalued. Look at Costco wholesale trading in the United States market right now. Costco is beloved for its sticky membership model and incredibly high retention. But the stock is trading at over 50 times its forward earnings. That is a higher multiple than most fast-growing software companies enjoy. For a grocery retailer growing revenue at single digits, this is absurd. Investors are paying a massive premium just for the feeling of safety. If economic growth slows, Costco's multiple will contract violently toward historical norms. The luxury sector in Europe is showing identical signs of massive overvaluation. Ferrari trades on the Italian exchange under a luxury consumer multiple, not automotive. It currently commands a forward price-to-earnings ratio of nearly 50. Yes, their order books are entirely full for the next several years, but a car manufacturer cannot scale production infinitely without ruining its exclusivity. Over in the UK market, Rolls-Royce has enjoyed a spectacular multi-year turnaround. Its aerospace servicing revenues have surged back to pre-pandemic record highs. However, the momentum has pushed the valuation to 40 times forward earnings. The turnaround is fully priced in, leaving no margin for operational error. Before we move to the undervalued gems, you need to hear this warning. If you want to systematically avoid these overvalued traps, hit subscribe right now. We track these volatile shifts in global equity valuations every single week. Now, let us look at the massive global software giant Microsoft. Microsoft has embedded generative artificial intelligence into every single part of its ecosystem. Azure cloud infrastructure continues to grow at a very healthy double-digit clip. However, its forward multiple has expanded rapidly to over 35 times earnings. This requires Microsoft to add tens of billions in fresh revenue just to justify it. Palantir Technologies is another clear example of retail hype overtaking actual fundamental value. Its commercial data analytics platform is seeing unprecedented, explosive demand right now. Yet, trading at nearly 80 times forward earnings is statistically speculative. The company must sustain 50% growth for years to break even here. Rounding out our overvalued list are two more major global tech players. Apple is currently trading at an incredibly steep forward multiple of 32. Hardware sales for the iPhone have remained largely flat in major global markets. The artificial intelligence upgrade cycle is moving much slower than Wall Street anticipated. Finally, we have CrowdStrike trading at a highly elevated valuation premium. Their cybersecurity platform is excellent, but the market has priced it like a monopoly. Any minor security breach or software glitch creates an immediate asymmetric downside. Frustratingly for some, the market always creates incredible balance by mispricing stocks on the downside. What most people do not know is where the real value is hiding. While tech steals the headlines, massive companies are trading at deep discounts. Alphabet is currently the most undervalued mega-cap tech stock in the world. It trades at a forward price to earnings multiple of just 20. The market is terrified that artificial intelligence search will destroy Google's advertising moat. This fear is completely overblown because Google dominates global internet infrastructure. They own Android, YouTube, and the most advanced consumer data network. We see the exact same unwarranted pessimism hitting the global automotive sector. Volkswagen Group is trading at a forward price to earnings of just 4. The market is pricing Volkswagen like it is going completely bankrupt tomorrow. Investors are terrified of Chinese electric vehicle competition and high European labor costs. Yet Volkswagen generates massive cash flow and holds valuable premium brand portfolios. They own Porsche, Audi, and Lamborghini, which provide incredible downside protection. Over in the UK, British American Tobacco offers an identical deep value setup. It trades at an incredibly cheap 5 times its forward earnings. The company is successfully transitioning consumers toward reduced risk nicotine portfolios. While you wait for the revaluation, it pays a secure 10% dividend. The financial sector is also offering some of the best discounts today. PayPal Holdings has been completely discarded by Wall Street over checkout competition fears. Yet PayPal still processes over $1 trillion in global payment volume. It trades at a forward price to earnings ratio of just 11. Management is aggressively buying back shares using billions in consistent free cash flow. In Europe, BNP Paribas is trading at just 6 times its earnings. It is one of the strongest, most diversified banking institutions globally. High interest rates are boosting their net interest margins to record highs. The market is ignoring this profitability due to general European economic anxiety. You can also find massive discounts in the global healthcare space. Pfizer is trading at 11 times forward earnings after its post-pandemic slump. The market has completely erased all value from its massive oncology pipeline. Pfizer has used its cash reserves to acquire leading cancer research firms. This long-term value will take a few years to fully realize. Meanwhile, target audience favorites like Target Corporation are also trading very cheaply. Target is currently valued at just 13 times its forward earnings. Temporary inventory issues and consumer spending headwinds have beaten the stock down. However, their digital fulfillment infrastructure remains incredibly strong for the long term. To wrap up our undervalued list, we look at 3 global giants. Diageo is the world leader in premium spirits, owning Guinness and Johnnie Walker. It is trading at a multi-year low of 15 times earnings. Consumer destocking in Latin America has created a perfect short-term buying opportunity. Next is Unilever, trading at 16 times earnings while transforming its business model. They are spinning off low-growth assets to focus purely on power brands. Finally, we have energy giant Shell trading at 8 times forward earnings. Shell is generating massive free cash flow and buying back billions in stock. They are heavily outperforming peers while trading at a significant valuation discount. The secret to market outperformance is avoiding the hype and buying value. Stay safe and watch out for our daily breakdown tomorrow.